world is on a precipice of a major shift. The monetary reset has begun, and we need to get ready. This program aims to inform you on how the monetary system works, how it has been used to rob you of your wealth. I will take you on a journey of discovering what has happened until now, what events are shaping how we will live our lives, and how you can prepare yourself for the biggest wealth transfer in history. There is a misunderstanding or no understanding of how inflation and interest work, why it goes up or down. I'm going to try and simplify it in this episode. There is one apple, and there is 1 rand to buy the apple. That means the apple will cost 1 rand. I produce another rand, making a total of 2 rand. But there is still 1 apple. That means the apple will now cost 2 rand. The apple didn't increase in value, it was the amount of currency that doubled, or rather decreased in its value, making the apple cost more rands. This is called inflation, when there is more currency than there are products or services. When there is more money in circulation, the illusion of wealth comes to the fore, and so more people have more money to spend, and because of that, the products and services will cost more. Just like housing, when there is more money, there are more buyers, and therefore the price of the house increases to match the amount of money that's available. Similarly, when times are bad, money is limited, so selling your house becomes more difficult, and the offers coming through are limited, and so is the value being offered. Interest is added to the amount borrowed when you loan money from the bank to buy a product or service. The interest rate at which you borrow is based on your ability to pay it off, and your risk profile will dictate your rate. When there is an abundance of money, interest rates tend to stay at current levels. But when debt is being used recklessly, or there is too much inflation, central banks will increase rates to curb some of the spending. Similarly, if people are not spending, or in the case now where people are battling and need reprieve, central banks will reduce the interest rate to provide the consumer with more available money through less charges, and so they can spend more. That's why it's called currency. It's like a current, it needs to flow. In March and April of this year, South Africa's Reserve Bank dropped the interest rate by a total of 2%, meaning that the consumer could benefit by paying less on their mortgage, or their car, or their credit card, and have extra money available for food and other essentials. Dropping the interest rate should make it more attractive for someone to buy a house. But during this crisis time, consumers will start holding on to their cash and spend it only on necessities. Holding on to their money in the bank, the interest they were receiving on their savings has now also been reduced by 2%. So if you have 100,000 Rand in savings, making 7% per annum, means that your money has made you 7,000 Rand. Minus taxes of 40%, you are left with 4,000 Rand on top of your 100,000. This gives you a total of 104,000. Inflation at the moment is at 6%. The 100,000 you started with 12 months ago is now only worth 98,000 Rand. So for example, if you wanted to buy a car for 100,000 but waited a year, you would have had 104,000. But that car now cost you 110,000. Inflation has hurt your ability to save, and the interest that you have received after taxes did not keep up with inflation. So the central banks never lose. Now with all this going on, and the people now looking at life differently, their spending habits are going to change. They will be more careful, taking on less risk. This lack of spending will cause deflation. Prices will start to drop in housing and other, and still people will not spend, therefore making the amount of money in circulation less. Governments will need more money and will borrow from international investors, other countries, or the IMF and World Bank to help big business and local banks stay afloat. In an effort to curb unemployment and debt defaults, and with our credit rating being reduced to junk, our interest rate on these loans will be astronomical. This money will then flood the country, providing the illusion of things getting better, like you getting a loan or a cash injection or having extra cash now. And then the money that the population stored under their mattresses will start to come out, and there will be more money than products or services, causing inflation to skyrocket. The simple solution would be to take money out of the economy, to create balance, but with the new government loans and the interest that has to be paid, this money has to stay to finance those debts. The debt problem starts to get out of hand until eventually liquidation. We cannot keep getting credit cards to pay off other credit cards indefinitely. At some point you will liquidate, and there needs to be drastic measures to curb unnecessary spending, reduce corruption, including arrests, and move away from the dependency as a nation from the central banks and their loans. A company's or country's success should be based on their ability to produce products or services and provide employment, not by increasing their share price or their cash position through debt. We should move toward a longer-term, sustainable model which will have some pain versus short-term gain, where future generations are born with a debt burden in future taxation, poorer quality of life over their heads from their first breath. Subscribe to my channel, like, and share this video. Thank you.